This simple smart money concept trading strategy can help you to become a profitable trader. So in this video, I will show you to trade using it, starting from learning the market structure and the rules needed to get you started step by step. Whether you're a beginner or an experienced trader, my goal is to help you to develop your trading skills. So, if you are ready to take your trading skills to the next level, stick around till the end because this video will provide you with some valuable information and details. Traders, welcome back to Easy Forex Strategy, where we help you navigate the exciting world of Forex trading. In today's video, we have a treat for you. We'll be diving deep into smart money concepts for Forex, cryptocurrency, stock, and even indices trading, covering everything from the essential rules to a real chart backtesting. So, let's get started. We will start with a full detailed structure with all the rules. To succeed in Forex trading, having a well-defined structure and following a set of rules is crucial. We'll walk you through a detailed structure that covers the key aspects of the trading strategy, including entry and exit strategies, and more. Remember, following a structured approach not only helps you stay disciplined but also minimizes emotional decision-making, which can often lead to poor trading outcomes. Now, to put our rules to the test, we'll conduct a real chart backtesting session. Backtesting involves applying our trading strategy to historical price data to evaluate its performance. This helps us identify strengths, weaknesses, and potential improvements. By reviewing our trades in hindsight, we can gain valuable insights into the effectiveness of our strategy and make necessary adjustments to enhance our trading edge. Backtesting is an essential step towards becoming a consistently profitable trader. Moving on, we will explore the concept of fair value gap. In trading, a gap occurs when the price jumps from one level to another without trading at the intermediate levels. Understanding fair value gaps is very important as they can present excellent trading opportunities. By identifying these gaps and analyzing their implications, we can potentially profit from price correcting towards them. Protecting your capital is very important in trading, and one way to do that is by placing effective stop-loss orders. We'll discuss various strategies for placing stop-loss orders to avoid being prematurely stopped out of trades. By strategically placing stop losses based on market conditions, we can strike a balance between risk management and allowing trades enough room to breathe. This helps to avoid unnecessary stop-outs and improves our overall trading performance. As a bonus, we're offering you a free PDF guide that complements the topics covered in this video. It's a comprehensive resource packed with additional insights, examples, and tips to help you to improve in your trading. To get your hands on this valuable guide, make sure to watch the video till the end. We'll provide instructions on how to download it and take your trading skills to the next level. On this section of the video, we'll explore the structure step by step. To help you grasp the concept effectively, I've provided a visual representation of the pattern on a real chart here on the right side of your screen. Make sure you have a notepad or your favorite note-taking app handy because you'll want to jot down some key points along the way. We will be focusing on a bullish market structure pattern, but during the video we will also do more bearish setups. To begin, it is very important to identify a previous low that has either been broken or manipulated, as we can see from here. Moving on to the second step of the strategy, it is essential to ensure that the price has traded above the previous high before proceeding with any further with the analyses. This step acts as a confirmation that price action might again try to be bullish, or we can say price has broken the market structure. Moving on to the third step, it's time to identify a demand zone. Remember, in the demand zone, we look for opportunities to buy, while in the supply zone, we aim to sell. It's worth mentioning that some traders refer to these zones as order blocks. However, it's important to note that the terminology itself doesn't determine our success as traders. Feel free to use any name that resonates with you because what truly matters is understanding the concept and making profitable trading decisions. Before we proceed further, let's take a moment to recap the essential skill of drawing supply and demand zones accurately for those who forgot on how to draw them. Mastering this skill is pivotal for making informed trading decisions. For a more comprehensive understanding of drawing supply and demand zones, I have provided a link in the description below to a dedicated video that covers this topic in detail. Make sure to watch the full video to refine your skills. To understand how to draw a demand zone effectively, in the first chart pattern, to do this, we locate the last bearish candlestick before an uptrend and use it as a starting point for drawing the demand zone. Moving on to the second image, we observe two consecutive bearish candlesticks before a preceding bullish momentum. These two bearish candlesticks collectively form a demand zone. Identifying such candlestick patterns allows us to pinpoint potential areas where buying pressure may emerge in the future. On the last image, although it may appear complex at first glance, a closer look will reveal that we have only one bearish candlestick before subsequent bullish candlesticks. Consequently, this last bearish candlestick will form a demand zone if we choose to draw it there. The key is to identify areas where buying pressure is likely to appear. We have two different approaches to drawing supply and demand zones. Let's explore one of those methods through this example. Here, we draw the zones based on the high and the low of the previous bearish candlestick. By using this method, it's important to acknowledge that your trade setups may carry a slightly higher level of risk. However, the advantage of this approach is that you won't miss any potential entry points. This means you can enter more trading opportunities. While this method may have its drawbacks, it's crucial to evaluate the risk-reward ratio and manage your trades effectively. Another approach to drawing supply and demand zones. This alternative method involves starting from the open of the previous candlestick. In the three examples shown, we initiate the drawing of the zones from the open of the preceding bearish candles. Then we extend the zone to the low or the wicks of either the bullish or bearish candles, depending on which one has a lower low. One advantage of this method is that it offers less risky trades. However, it's worth noting that the market might not always trigger your entries, resulting in fewer trades being executed. Nonetheless, when the market does trigger your entries, they often turn out to be precise and sniper-like. By using this method, you prioritize higher probability setups while being patient for the perfect entry. This approach allows you to fine-tune your trade selection, ensuring that you enter the market with a greater edge. I will advise you to always use this method because, us traders, we don't like to see red in our MT4 when we enter a trade. Now let's introduce fair value gaps or an imbalance. A fair value gap refers to the space between the wicks of two consecutive candlesticks on a chart. These gaps typically occur during periods of high market volatility or significant news events. When a fair value gap emerges, it indicates a temporary mismatch between the perceived value of an asset and its actual price. Combining market structure, supply and demand, and fair value gaps allows us to create a more comprehensive trading strategy. By integrating these concepts into our analysis, we can make better informed trading decisions. Before we can take any trades, we should also see a fair value gap above the demand zone, because we want to see price action closing it before triggering our trade setup. Also guys, after watching this video, you should also go and backtest so that you can really see how the market behave on a daily basis. So let me show how a fair value gap looks like on a real chart. Let's observe a fair value gap on the right side of our chart. This indicates a huge selling pressure in the market, resulting in a downward surge that leaves behind noticeable imbalances in the market. From a bullish perspective, the aggressive buying activity creates an environment where demand outpaces supply, leading to substantial price movements. These imbalances become an important focus for trade setup as they often indicate areas of potential support and future reversal area. Now we will focus on how to make entries using two key methods. But before we delve into that, let's recap the essential rules we've covered so far. The first rule is understanding market structure by analyzing the way price moves and forms patterns on a chart. The second rule involves identifying fair value gaps. These gaps represent imbalances in price action. The third rule entails plotting demand zones on our chart. Demand zones are key levels where buyers are likely to enter the market. Now that we have covered all the rules, on this first example we will use a buy limit order on the previous bearish candle's high, and then our stop loss will be below the demand zone. This entry doesn't even require a confirmation. And another way of using a buy limit order that will reduce the risk into your trade setup. You can put a buy limit order on the open of the bearish candlestick. Stick around to see that example. We will explore the second method of entering the market called a confirmation candle. This technique allows us to enter a trade once we observe a candlestick that closes in the direction we have anticipated. Let's take a closer look at how the confirmation candle works. In the example we have on our chart, we are looking to take a bullish trade setup. To enter the market using this method, we wait for price to close the fair value gap and touch the identified demand zone. Once these conditions are met, we exercise patience and look for a specific type of candlestick to form. In this case, we are waiting for a bullish candlestick to close. The bullish close provides confirmation that price has a high probability of moving in the anticipated direction, in this instance, to the upside. By waiting for the confirmation candle, we aim to increase the accuracy of our entries and align our trades with favorable market conditions. It's important to note that using the confirmation candle method may result in missing out on some quick entry opportunities. However, to overcome this potential downside, we have a dedicated video linked in the description below that that will teach you how to sniper your entry, even when utilizing a confirmation candle. In that video, we will cover advanced techniques to help you pinpoint optimal entry points while incorporating the confirmation candle strategy. This will enable you to effectively time your trades and maximize the potential for profits. It's crucial to recognize when a pattern becomes invalidated due to certain price actions. Invalidation occurs when price trades below the identified demand zone before the market can close with a bullish candle. Let's take a closer look at an example to illustrate this concept. In this example, we can see that price action closed the fair value gap, touched the zone, and closed with a bullish candlestick. However, a critical factor to note is that price traded below the demand zone before the market can close with a bullish candlestick. When this type of scenario occurs, it indicates that the trade setup has been violated. As traders, it's important to understand that not every setup will work out as planned. By acknowledging invalidated patterns, we can protect our capital and avoid unnecessary losses. Now you will see the importance of starting your analyses from the higher time frames. By using the higher time frames, you will see and sport that structure very easily using one of our tricks. So to access all the necessary time frames and materials used in this video, we have prepared a PDF for you. To obtain the PDF, we invite you to join our free Telegram channel. The link to join will be in the description below. By joining our Telegram channel, you will gain access to the PDF, which contains detailed information on the different time frames required for effective analysis. The PDF will be in our main Telegram channel files. By now, you should be familiar with engulfing candlestick. An engulfing candlestick pattern occurs when the body or a volume of one candle completely engulfs the body of the previous candle, and the two candles are of different colors. Let's take a specific example to illustrate this. On the right side of the screen, we have a bullish candlestick, indicated by its green color. Then we have black candlestick, which is a bearish candle. In this pattern, the bearish candle's body is larger than the previous bullish candle's body. Most of the time, an engulfing candlestick will give us an indication that the market might reverse. After identifying an engulfing candle on the higher time frames, then the next step is to draw a horizontal line on the body of the previous candle. This horizontal line will serve as a reference point for making entries in the lower time frames. By placing a horizontal line on the body of the previous candle, we create a visual guidance that helps us determine potential entry points in the lower time frames. The primary motive behind using this horizontal line is to help us capture the next swing low or high on the higher time frame chart, using the lower time frame to enter the market with a low risk. So now let's do a full detailed example on how to combine everything you have learned so far from this video. From this example, we can see here on the right that we are on the daily time frame. So this horizontal line that we put in the daily time frame will also be available on the lower time frame. So the lower time frame of the daily time frame is the 1 hour time frame and also the 30 minutes time frame. Then on the left side, we can see that the horizontal line is still up in price. So the only thing that we need to do is to find a supply zone and a fair value gap above the daily time frame horizontal line. And most of the time when you move on to the lower time frame, you are most likely to find the structure that we have been talking about throughout the video. So once you have identified your break in market structure pattern, a fair value gap above the red line and also a supply zone, is when you should practice your patience in trading. And before I forget, you should also write down all the rules because they will be very important once we start backtesting. This will also help you to be an individual trader rather than focusing on trade signals. Once you start trading, you should also learn to do things yourself and improve your craft. So now let's start with the first example and see how this trading strategy works on a real chart. We can see from this example that the market is very bullish but in a corrective pattern. So meaning once the market is corrective, the next upcoming move can also be impulsive. If a correction is bullish, the impulse will be bearish. But if you want to learn more about impulse and correction, I suggest that you subscribe to the channel so that you don't miss our upcoming videos. And also give this video a like and share it with your friend and family who are starting to trade the market. Let's zoom at the current price action and follow all the rules that we have covered from the video. The first step that we need to do is to spot an engulfing candlestick. So from the current price action, we can see that we have a bearish engulfing candlestick. The second step is to plot the horizontal line from the open of the previous bullish candlestick. We are now done with the higher time frame. But before we move on, you see the high of the bullish candlestick before a bearish candle. The candle will act as our invalidation level, meaning if price trade above that price area, it will make this setup to be invalidated. Because we are on the daily time frame, now let's move on to the lower time frame, which is the 1 hour time frame. Here we can see the same two line that we have made in the higher time frame. So for now, let's all plot all the rules to the chart and follow them by order. From here, traders, we will follow all the rules needed to trade this strategy efficiently. For now, we have to find two things in between the two red lines, which is the supply zone and the fair value gap. Then lastly, we have to make sure that the setup is aligning with our analyses by finding a break in market structure. Now we can see that we have a supply zone above the red line. And remember, the supply zone that you choose, it must be close to the fair value gap. We can see that the market manipulated the high of the previous candle. It may be a hidden supply or selling pressure in that area. This manipulation can act as a signal that the market is actively working to push prices lower, potentially trapping traders who are holding long positions. When we identify a fair value gap followed by a supply zone, our analysis suggests that the market is likely to close that fair value gap and touch the supply zone before potentially moving lower. This scenario sets the stage for a potential sell position. By waiting for the market to close the fair value gap and reach the supply zone, we increase the probability of a favorable trade setup. This approach aligns with the principles of supply and demand as well as market structure analysis. And finally, in our analysis, we need to identify a break in market structure to ensure that we are following the market's direction rather than going against it. Market structure refers to the patterns and formations that the price creates on the charts. It typically consists of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. So to clean up our analyses, our trade analyses will look something like this. Then you will put a sell limit order on the bullish candles open before a bearish candle that we drew the zone at. And also make sure that you calculate and add the spread size above the zone to avoid being stopped out. If you would like to know the broker that I am using, the link will be in the description below with a small spread size, and they don't manipulate price like other brokers. When setting our take profit level, we will be targeting previous lows as our potential profit target. By aiming for these levels, we take advantage of areas where the market has previously shown support. Now let's see how the market unfolded after setting up our sell limit order. We can also see that this is a sniper entry. You won't have to wait for any confirmation. You will just enter the market and see blue inside your MT4. Let's walk through another example of a bullish trade setup using the 4-hour time frame. This example will demonstrate the versatility of the strategy across different time frames. We will also follow all the rules that we have used before. Incorporating other trading theories and techniques can further enhance your trading analysis and decision-making process. You can also use other techniques like Elliott wave theory and support and resistance. Elliott wave theory. This theory suggests that markets move in repetitive wave patterns, consisting of impulse waves in the direction of the main trend and corrective waves against the main trend. Support and resistance levels are areas on the chart where price has historically shown a tendency to reverse or stall. These levels can be identified by drawing horizontal lines at significant price points, such as previous swing highs or lows. Zooming in to get a closer look at the current price action, we can see that price is at the previous support level. The combination of price being at a previous support level and the presence of a bullish engulfing candlestick pattern adds strength to our bullish trade setup. Then the next step is to follow all of the rules we have covered before we can move on to the lower time frame. On the higher time frame, we will only do two things, which is to put the horizontal line on the previous candle's open. Then lastly, we will put a horizontal line on the low of the bearish candlestick's low. This last horizontal line will be used as an invalidation level, for in case if price trade below it, we will believe that our trade setup has failed. And remember, traders, that in the lower time frame we will be looking to enter the market below this first horizontal line. So now that we are on the 4 hours time frame, we will be looking to enter the market in the 15 minutes time frame. So now let's move on to the 15 minutes time frame and find a valid structure to trade it. As we move to the 15-minute time frame, we will follow the 3 rules we need to find the trading structure more easily and identify them in the current price action, market structure, fair value gap, and demand zone. Now, if we take a closer look below the horizontal line from the higher time frame, we can see that we have a clear demand zone, and we have a manipulation of the previous low before the market can make a new high. Most of the time, you will see that before price can make a new high, it will firstly trade below the previous low. So this topic will mostly be on another video. Be sure you are now subscribed because you might miss that video. So now let's find the fair value gap before we can make any trading decision. The fair value gap must be closer to the demand zone because this will also give us an edge that we need to buy at the lowest price action. And traders, if you do this consistently, you will be able to see them very easily. So from the current price action, we can clearly see that the fair value gap is very close to the current demand zone. Now to clean up everything, our analyses will look something like this. Also guys, to be a better traders, you must also train yourself to be patient. Always wait for best trades only, so that you don't make bad decision because you want to be in a trade every day. So now let's see how the market unfolded after setting up our buy limit order. At the previous bearish candles open, and also the stop loss will be below the zone with added spread. As you can see, the market triggered the entry, but price is still playing around. As I said before, your take profit levels will be at the previous swing highs. And this trade is also a sniper entry. Traders, I guess this is the end of our video. So if I have missed any information, I will also add them in another video. To show that you have reached the end of the video, tell me how many years have you been trading and which country are you watching this video from? I guess we have reached the end of the video, but I won't leave you with nothing. I have included more examples, so you may keep watching. And last but not least, if you join our Telegram, you will be able to communicate with me so that I can help you for free. Stay safe and always use a stop loss in your trading.
whip up my appetite. Don't leave me here high and dry. Oh, well, I don't wanna jinx it, baby. Can't twist myself at the spine. Don't wanna overthink it, baby. It's just twist your body and mine. Baby, you give me ice and fire. You're giving me wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here high and dry. Oh, but I don't wanna jinx it, baby. Let's not get ahead of my time. Oh, but I don't wanna miss you, baby. So I stand up and speak just my mind. Oh. Baby, you give me ice and fire. You're chilling wind and rain. You're some kind of butterfly. Baby, you give me midnight. You whip up my appetite. Don't leave me here